This looked like a foreboding week with a Federal Reserve meeting, Dutch elections, the National People's Congress in Beijing, and a triple witching day on Friday when a mass of equity derivatives expire. But instead of the Ides of March, we had the March of the Bulls. The Fed did raise rates, but declined to quicken its pace. The Dutch populace did worse than expected, and China even managed to quietly tighten monetary policy without upsetting markets. Nor does Friday's rash of futures and options expiry seem to faze investors, despite its tendency to unsettle markets. As a result, Europe's fear gauge slumped to its lowest level since before the financial crisis on Thursday, and the Treasury Bond Turbulence Index has fallen to its lowest level since before the US election. Now, the S&P 500 did give up some of its gains on Thursday, but the global stock market powered to a new record high. Now, this euphoria can be largely attributed to two factors. The Dutch elections show that populists aren't necessarily going to sweep the European board, and the Federal Reserve won't tighten monetary policy too zealously. Now, nonetheless, there are some clouds lurking on the horizon. The US equity rally in particular has been fueled by hopes of comprehensive tax reform, but that looks increasingly unlikely to materialize this year. Meanwhile, US earnings estimates have actually been darkening. And whilst traditional fair gauges are fairly placid, other measures betray some rising nervousness. For example, the SKEW index, that measures the relative cost of plunge protection, has been inching to its highest level since right after the UK's Brexit vote. Buoyant market reaction to Wednesday's US rate increase could also encourage the Fed to turn more aggressive. So, markets are increasingly pricing in perfection, but the real world is sadly a bit messier.